Okay, so I'm going to try and cover two topics. One is state of VC, and admittedly, I'm going to try to be a little bit controversial here to see if we can, if people actually think this is a correct statement. And then we're going to talk about, if we have time, I'll talk a little bit about, the B word bubble, because I think it still seems to be everybody's favorite topic. So, I think the short answer on the state of the VC market is, I think Bob Dylan had it right, even if he wasn't talking about the VC business. Number one, I think the good news is that the VC environment is very healthy from a supply side. So if you look at any measure of dollars coming in the industry, the supply side is quite good. So I think everybody knows these numbers, but about an average of 17 billion coming into the industry over each of the last 5 years. That's down from something like 27 billion in the 5 years prior. And then very down from, of course, when we hit our peaks, which was 55 billion in 1999 and 106 billion, in 2000 in the year 2000. So that's, I think, a good thing, which is the supply side of the business is quite good. And the other thing that's happening, which I think everybody probably knows, is that dollars invested for each of the last 7 years has actually outstripped new dollars raised into the industry. So I think another indication that the industry is kind of right-sizing relative to overcapitalization that happened kind of in the 99-2000 timeframe. But what's interesting is the nature of these dollars is changing, and that's at least what I want to spend a little bit of time talking about. Here's a couple stats, I think, to kind of capture this. Number one is concentration of dollars among the top firms. So from 2000 to 2003, these are the best numbers I could get. Top 10 firms raised about 17% of the dollars in the industry. If you fast forward to 2012, the top 10 firms raised about 48% of the dollars. Almost half the dollars were raised by the top 10 firms in 2012. I don't think the numbers are actually meaningfully different from 2011 or 2013. And then if you look at the nature of new fund formation, almost all the new fund formation is happening in the sub-$100 million category. So again, what I was told, if you look at the data, basically, there's about 50 first-time funds that have been raised in each of the last 5 years, and this is kind of excluding incubators, because I think if you added incubators, you'd probably have a much, much larger number. The average size, if you just do the math, and I'm sure average is probably not the best number, but it's about $28 million. So all the new funds are being raised, obviously, certainly sub-$100 million. And there's probably from about 100 firms that we had in 2007 that were sub-$100 million. There's, as best as I can count, there's at least 500 today that are sub-$100 million. So interesting dynamic happening in the industry, which is concentration of dollars in relatively small number of firms, but at the same time, interesting, significant new fund formation happening kind of in the smaller end of the market. So that's kind of the general dynamic. And so what's going on here and why is this happening? And so I'm going to offer up at least our theory of what's happening. And I think it's very simply put, kind of the death of the middle. And what's happening here is you see across a lot of industries, and I'm going to give you a couple examples, that over time as industries mature, particularly professional services industries, they tend to bifurcate to the extremes. So you tend to have kind of boutique and specialization firms on one end, and then you tend to have kind of larger, kind of almost full service firms on the other end. We've seen this before, so this is kind of the quick laundry list of almost every industry. If you look at what's happening in investment banking, there's 4 or 5 money center banks that actually matter, and then there's a lot of boutique specialization. Accounting firms, it's happened in advertising agencies, talent agencies, law firms. If you look at this, right, you can see this today in the number of bankruptcies and the number of mergers happening in the law firm industry. And then probably more really interesting in the retail space, since that touches all of us, we used to have these things called department stores. And really what's happened, the department store was the canonical middle of the industry. And now if you look at what's happened, you've again had this bifurcation, which is you have Amazon and Best Buy and kind of large big box retailers on one end, and then you have kind of boutique specialization on the other end. So the obvious question then is, why is this happening now in the venture capital industry? And then I think the other question, of course, is this a good thing or not? So I think on the boutique side, the reason I think this is happening is we know that the cost of starting companies has gone down tremendously. So I don't think that's a surprise to anybody. But anywhere from 10x to 100x, even if you look from 99 until today, whether it's storage costs, networking costs, bandwidth costs, server expenses, all of that is going down significantly. And because we have something called the internet, as long as it's actually available for everybody, you effectively get your initial distribution for free. You don't have to ask permission to actually enter the business. And so what I think that means, and I think this is why you see all this new fund formation at the smaller end of the spectrum, is that you can actually raise small amounts of money, kind of as you heard today, and get a business going and kind of see if it takes or not. Now, if you look on the other end of the curve, The other thing we also know, though, is that the end user markets are dramatically bigger than they've ever been. So again, if you just think about internet population, about 250 million in 1998, exceeded 2.5 billion last year. If you think about phones, just talking about all phones, 5.5 billion cell phone users, only 30% of those today are actually smartphones. So if you believe, as certainly we do, that over the next 3 to 5 years, you'll have a wholesale turnover of feature phones into actual smartphones, there's potential opportunity to reach 5.5 billion people, both in developed and developing countries. And you see this already in the numbers. So most people probably know this, but Twitter, 80% of the users are actually international today. If you look at companies like Airbnb, very, very significant international distribution and revenues already in their business. Spotify started ex-USA and came here as a secondary market. So you're already seeing kind of what the opportunity set is that the bigger market really creates. And then I think the other thing that's probably most significant that I think people forget about is while all of this has been happening, time to IPO has basically doubled. So if you go back to 99 and you look at actually what happened in the class of 99, and actually for almost the entire 25-year history from 1975 to 2000, average time to IPO for a venture-backed company was about 4 years. That's now gone to 9 years. And so what you have is small amount of money to get started, very, very significant market opportunity for the winners. At the same time, those companies are staying private longer. And so I think this is why you're starting to see this kind of bifurcation of the industry from a funds perspective. If you think about Facebook, right, for as well as Facebook has done as a company, it took them $5 billion in the private markets before they actually went public to get to where they are today. Add up the dollars that have been raised. You've all seen them: Airbnb, Pinterest, Uber. You can probably name your favorite: Lyft, Square. The size of the opportunity is significantly greater, which is driving, I think, the greater capital and resources in this environment. So I think the quick summary of why this is happening now and what it means is, you've got great opportunity to kind of build businesses from a start with small amounts of capital. And then if you're actually winning and want the opportunity to win, there's a great opportunity to do that. But to do that, you actually have to have significant amounts of capital. And so I think that's, again, what's kind of driving this wedge between the businesses. All right, I'm going to take less than 1 minute on this because I know I'm out of time. So for those of you who weren't there, this is a bubble. This is where we are by comparisons for 2013 and year-to-date 2014. We'll probably, I think we will probably get to roughly the same run rate of tech IPOs. And by the way, this is just tech, just to make it clean, so I took out all the other numbers. But despite all the articles you read about how robust the IPO market is, you got to remember we essentially had 12 years between 2000 and 2012 where you had virtually no IPOs. And so when you're talking about an overall IPO environment that's generating a little north of 100 IPOs a year, the prior kind of 30 years from 1970 to 2000, we basically had over 300 IPOs a year consistently, and that's not just tech, that's all. I think the talks about irrational exuberance in the IPO market are a little bit overdone. You guys can read these numbers. I talked about this before. This is a simple comparison. The message is the same in all cases, basically, which is companies are staying private longer. Therefore, they're more mature at the time they have IPOs. And at the same time, the supply side of this business is constrained. So again, when I think people talk about bubble activity and think about the 99-2000 timeframe, and I was a banker in that timeframe, so I was certainly part of the problem, not part of the solution, the industry is just dramatically different kind of from where we were today. So despite all that, though, why is there all this fear, and what are the things that people are worried about? So a couple things are happening when you read the popular press that I think it's important to understand. One is non-traditional investors. So there's no question that mutual funds and hedge funds are active in this market. This number is now out of date by at least 2 companies. So the New York Times ran this article about a month ago. 88 of the largest VC rounds in the last 5 years of the 100 happened in the last 5 years. It's actually now 90 because Uber and Pinterest, I believe, were not in that number. And then the huge number of IPOs, which hopefully, as you've seen, when you compare those numbers to kind of what happened in the 99-2000 timeframe, is pretty different. So I think the answer, though, is we shouldn't be worried, at least not yet. Now, we will get to a bubble at some point in time. That's the natural course of how all these asset classes work. But we're not there yet. And I think there's a couple reasons that hopefully you guys will appreciate. Number one, as I mentioned, is dramatic changes in the equity capital markets. The first being because companies are staying private longer, it's not surprising to see billion-dollar valuations in the private market. These are all companies that would have gone public in a normalized 30-year environment that we had from 1970 to 2000. They're now staying private longer. We've shown that by more than double the time period. And so what is happening is you have almost a shift of wealth from the public markets into the private markets. And the starkest example of this is think about Microsoft. Microsoft went public at a $500 million market cap. Today, Microsoft is somewhere around $300 billion or something. So that's 500x appreciation in the public markets. If you just do that math on Facebook, right? So Facebook went public at $100 billion. For Facebook to get anywhere near that number, they would actually have a market cap that exceeds the entire market capitalization of the global listed stock market today. So those are an extreme example, but again, what I think what it illustrates is you're seeing is a shift in dollars from the public markets to the private markets. I think that's good for all of us in this room, which is it means there is tremendous opportunity to make money as an investor in the private markets, but I think this is a pretty significant change. The second thing that's happening, I think is important to understand, is there's basically zero growth happening in the large cap public tech market. So if you're Fidelity or you're T. Rowe Price and you're a mutual fund and your job is to actually invest in tech, there is $2.5 trillion locked up in IBM, Microsoft, Cisco, EMC, NetApp, you name it. Some of them are growing actually negative on the top line, but even as a class, they're all growing basically, probably sub 5% on the top line. If you add up all the IPOs that we've had, at least from 2011 to 2013, I haven't added in the 2014 numbers yet, there's only been about $300 billion of new market cap created, and Facebook is virtually 60% of that number. So you've got $2.5 trillion of large cap tech that's not growing, a new batch of $300 billion, and if you add up basically Facebook, Twitter, and LinkedIn, they're probably more than 75%, if not 80% of that number. So it's not surprising what's happening, which is investors are searching for growth. They're getting growth both in the IPO market and the private market, and that's certainly what's driving some of the prices. The good news, though, is investors are discriminating. What I mean by that is it's not a rising tide floating all boats like we saw in 99, 2000. The simplest way to look at this is if you actually split up the IPOs that have happened over the last 3 years into companies that are growing greater than 25% a year and those that are growing less than 25% a year, they're valued very differently. So investors are paying on average 6x revenue multiples for those companies that are going greater than 25% and 2x revenue multiples for those that are growing less than 25%. Interestingly enough, 2x revenue multiples is exactly what large cap investors are paying for IBM and for EMC and for Cisco and others. So that's a good sign, which is actually investors care about what they're investing in and they're being discriminating in the winners. And then lastly, we've talked about the VC supply side. So again, an industry that's taking in $16, $17, $18 billion a year, which is actually consistent with what the long-term 25-year history of the business is, very, very indicative, I think, of a healthy market. So I'm going to stop there and let Mark pick it up from here, but hopefully that gives you some perspective of how we're thinking about things.